Hello, friends. Once again, I welcome you back. So, it's been a long time ever since I uploaded. So, I'm back with another video. So, if you find it helpful, please endeavor to subscribe and you can leave a comment. I have a link to my Telegram. You can text me over there, it's going to be in the description. So, in one of the last videos that I uploaded, I was talking about inefficiency, and someone asked the question, what is the difference between an imbalance and an inefficiency? So in this episode, I'll be explaining those things, but some of the major things that I'm going to be talking about: imbalance itself, inefficiency, voids, and fair value gaps. You get? But if I can quickly summarize a little bit, inefficiency, voids, and fair value gaps are types of imbalance. Are a type of imbalance. So basically, when it comes to trading, you're going to find that when you understand these things, they're going to really impact a lot on your psychology. So even many strategies, they basically you can learn, but when you come on the root charts, you start battling with what we call psychology. But I believe this video will be helpful. So now, let me start with an imbalance. You get an imbalance. I believe an imbalance is it's where price delivery is not balanced. You get? Let me just say it plainly like that. It's a part of the market where price is not fairly, let's say, distributed, and then imbalances are good. Let me give an example. When we look at this part, at this area over here, we can see that prices are moving up and immediately they come down, where we get a consolidation. So personally, I can call this a fair distribution of price, whereby buyers are equal to sellers. You get? Buyers are equal to sellers. They complement immediately. You get? They come and fill up immediately. So we can say that this is a fair distribution of price. And then I can say that here it's a point of indecision. You get? No one is controlling the market, they are all equal. But then later on, we can see that the market cannot do that forever. Normally, the market leaves that area. For instance, if it has consolidated like this, it leaves that area either to go bullish, or sometimes it does something like that. So we know that. So normally, out of these consolidations, let's say, you get, when we have the market consolidating, then thereafter, as the market leaves, as it displaces from that region, normally we get an imbalance. You get? Whereby, let's say, sellers will dominate or buyers will dominate. But then the market behavior as we are leaving this consolidated area always differs. You get? So we are going to be looking at those different impulses, because okay, we can call this an impulse that that has left this area. So if at all, let's say, we leave that area and then we start forming structures like that, so we can say that this area can become an area of supply. You get? It could be that here in this region here, supplier sellers had a point of interest. Overall, they took over the market, much as initially it was a point of indecision. Later on, sellers took control, which means later on it is possible that as we return to this area, to this zone here, it is possible that the market may reach and then sells back again, or it may pull back a little bit and then we proceed up. You get? So these ones are going to become vital areas to the market, like to us marking up our charts. So now I've talked about what causes that. So then, as we are living in a given area, you get, in a given area, we are going to look, I'm going to give you a case example of two impulses. One is here, you get, and then another one is over here. So now, personal, I believe, because by the traders have different views on what we call an imbalance, and we validate imbalances differently. But everyone has their own style, much as we can be students of the same strategy. So when we look at these two parts, when we look at these two parts, we can see that here the market was bearish. Let me even zoom in a little bit more. We can see that the market in both of these areas was bearish here and here. So now, personally, there are those moments when you see only bearish candles or only bullish candles. So when we only see, let's say in this case, we are seeing most times when we see more than three, at least three candles that are of the same type, let's say bearish candles, then we can say there is that is an imbalance. Personally, I can say that that is an imbalance. I believe by the you guys, even in the coming episodes, if at all you subscribe and then you keep watching, you'll get my point of view. Likewise, in this area, you can see that only sellers are dominating. So we can say that this is possibly an imbalance. But remember, we are going to be differentiating which imbalance matters and which imbalance does not matter. Because what you're going to realize even in coming episodes is that the markets are manipulated. So they may display this to be an imbalance. Actually, now if at all there is actually, yes, they may display this to be an imbalance. On the face value, it may look to be only sellers dominating. So if there is an imbalance, if the market is not balanced, by the way, if at all we are living and then we're having imbalances, one of the reasons as to why the market pulls back is to cover up gaps, those imbalances, and then it proceeds down. It lives in an impulse, so we come back to retrace. Most of the time we believe that the market retraces to fill up those gaps. And then sometimes you can find that if at all we moved, there could be some other gaps that we were not filling, let's say in these zones here. In these zones, because we were filling, let's say halfway, and then we have more gaps over here. So now when you have those gaps over there, later on the market can come and then it starts to cover them all. Even these ones that were not filled before. And then by the on that point, we are going to be knowing more about what we call voids. In the end, by the way, guys, you'll be able to determine take profit points. Take profit points. So now we've realized that this is an imbalance and then this is an imbalance. Most of the time we like it when there is a break of structure. It's unfortunate that here there was no break of structure. Now this one is really, really good where there is a break of structure, because this is a sign that the market is moving from up, and then if it comes and then breaks this structure, then it's a very, very good way of looking for imbalances. But then let's leave that at that. Now I really want to show you an inefficiency. Now this is where the point of fair value gaps come in that video I was saying, when we see a candle that has a fair value gap, for instance, there is one here. There is one here, there is one over there. So now when we have a fair value gap here, we look at the candle. We look at the candle. We look at the, which means this candle here is inefficient anyways. We look at this candle as inefficient because there is a gap. You look here, we can see that we have this impulse from here to down here, but you're not seeing any gaps. Each candle starts, and then before the other one starts, it first runs into this one and then it drops. This one runs into this one and then it drops. Here you're not seeing any gaps apart from one over here. We're only seeing a fair value gap over there. So now this one becomes inefficiency. So now here I normally mark this candle as an area of supply. You get, it becomes an area of supply. Most of the time the market will come and tap here and then it will drop. So now you guys, I believe you can understand these are all imbalances, these ones, because we can see only sellers are dominating. But then the difference is that I'm bringing in, for me, an inefficiency is that part of the market where we are seeing fair value gaps. You get, where we are seeing fair value gaps. And then most of the times, now those gaps are what we call voids. You get, those gaps, we call them voids, whereby the market, we expect the market to come and fill them up and then it drops. Now the voids or the fair value gaps that matter are those that the market fills right away. You get, not always when the market leaves, fair value gaps will come to fill them right away. You get, let me, here I cannot get a quick example, but I'll be showing. For instance, we have, for instance, we have one here, and then we can see that, okay, later on the market came and filled it a little bit quickly. You get, so you can see that these ones are very good. I told you fair value gaps or voids are so good on what we call pullbacks. You get, so whenever we get some kind of reversal pattern during, let's say in this area, we get something like this, more so on a lower time frame, normally personally I like getting in and then I buy. You get, this is normally a pullback. It is a sign that the market is intending to go back up. You get, to go back up, and then sometimes, yes, that's a pullback basically. So the other thing that I wanted to bring out is yes. Now, what let's look at the relevance. You get, there's more that I'll be talking about in coming episodes. Let's talk about the relevance. Now, let me head over to MT4 and then I'll show you something. Now, those fair value gaps and all that, you're going to find that for Nasdaq, you get, for Nasdaq or the and even the US 30, you're going to find that it helps us to determine more so how we are going to prepare ourselves for the New York session. You get, because you know that these assets, more so on this channel I talk mostly about the Nasdaq. You can see that whenever it's the New York session, sometimes London and New York, there is a big movement that really happens. You get, but for instance, you can see that big moves are happening during New York. You get, and then during New York, that's when you're going to see that the market creates those fair value gaps, all those imbalances, because it starts to live in a displacement. Like, let's say it displaces, and then you can see that during the Asian session there is little movement. You get, there is little movement. So now, if at all, let's say we get these large displacements, which sometimes are a sign, sometimes they are a sign that the market intends to go, let's say, in a given direction. For instance, here we got this impulse that was so aggressive going up. You get, so normally the market will pull back, because during New York it overmoved, it left those gaps. So during Asian, it will slowly come back into those gaps. You get, and then there, during London, it starts to move, let's say, up. You get, likewise, let's say we move and then we complete a structure. This is M15, by the way. I'm not going to go on high time frames. Now we can see that here it completed the structure, and then you can see that during Asian we got a reversal. You get, we got a reversal. So during London, here you just mark up your zone here like that. We shall be seeing how to identify supply and demand zones. See, so you just mark up your area here during London, and then you will drop. You get, now London overdropped. You get, so if at all London, most of the time, there is a lot by the you guys I need to talk about. If London drops and takes out the previous day's low, you get, which was during the Asian session, Most of the time here, it was pretty easy for you to determine what would happen in New York. You don't expect New York to also just proceed like that. You get? No, 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 no. So yes, I'll be talking about that. So you can see that during New York, we were just even filling up the spaces of London. You get? So I believe those fair value gaps, and then voids, imbalances. Uh, as the more I talk about them, the more you'll come to appreciate them and like them more. You get? But mainly, I want you to understand what is the logic behind these impulse moves. You get? These impulse moves. You get? These impulse moves. And then the other thing, these impulse moves, not all of them really matter. You can see that we got an impulse here, but then the market didn't come back to fill it right away. So now, let me give you a quick tip. You can see, you need to ask yourself, where did this impulse come from? This impulse came from filling up this impulse, or these gaps here. You get? So we got a displacement from this region, but then we had come to fill up the displacement that we had gotten in during let me show you. During London, we can see that the market dropped sharply, and then we were leaving these gaps as we're seeing here. Those gaps that I've been talking about. The market normally comes back and then fills them up to where they started from. You can see that here there were no gaps up here. But then let me even change the color here to blue. You get? We can see that before we started getting these gaps here we were not getting them. So the market retraces back to that area where the market was the market was fairly balanced. You get? And then we drop again. You get? So it explains why the market didn't come back right away and we've been still continuing down. So you guys, I hope to share a lot of information. I just request you to be part of this. Please subscribe. You can hit me on Telegram. You can join. I normally hold some short boot camps, more so in SMC. You can join. They are a bit cheaper. You can be part of the mentorship program if you so wish. And then the most important thing is that I wish you to be profitable. Have peace.